Welcome to Iron Financial. This is the show where we forge stronger portfolios by putting market leaders under some serious stress tests. And today, we've got a titan in our sights, Chubb Limited. Look, they just dropped a performance report for 2025 that is, for lack of a better word, absolutely monumental. The numbers are frankly staggering, but you know how we operate. In this kind of market, strength is only as good as the foundation it's built on. So our job today is to figure out if this is a true financial fortress built on solid rock, or if there are cracks starting to show that we all need to worry about. Okay, let's get into it.
And you don't have to take my word for it. We're not just throwing around words like record year lightly. Those are the exact words from the man at the very top, Chairman and CEO Evan Greenberg, the best in our company's history. Now, when a CEO of a company this size makes a statement that bold, that definitive, it's our job to bring the receipts. We have to go way beyond the headline and scrutinize every single number, every metric that supposedly backs it up. You see, this isn't just a claim he's making, it's a challenge, and we're about to see if it really holds up under pressure.
All right, so let's start the deconstruction. We're going to frame this whole analysis around this idea of a financial fortress. A company like Chubb, a real blue chip, isn't just about having one good quarter or even one good year. It's about meticulously building an impenetrable structure that can withstand any economic storm that gets thrown at it. And what they did in 2025, well, they didn't just add a few bricks to the wall. It's more like they built entire new towers and massively reinforced the existing battlements. So let's start with the main keep of this fortress, the pure, unadulterated profit.
And here it is. This is the headline number, the main tower flying the flag of victory. $10.31 billion in net income. Just let that sink in for a moment. This isn't just a big number. This is a declaration of dominance in the entire global insurance landscape. This is the kind of heavy lifting, the sheer financial muscle that separates the true market leaders from everyone else in the pack. You have to understand, this is the core of their power. It's the treasury from which everything else, dividends, buybacks, investments, it all flows from this.
Now here's where things get really interesting for serious investors. Net income is fantastic, it grabs the headlines. But this metric right here, this is the one that cuts through all the noise. Tangible book value per share. So what does that mean? It means you take the company's book value and you strip out all the intangible stuff, goodwill from an acquisition, brand value, things you can't really touch. It gives you a much harder, more conservative measure of a company's real physical worth. And seeing growth of 25.7% here, that tells us they aren't just earning money. They are creating concrete, measurable, real value for their shareholders. This isn't just decorating the fortress. This is actively thickening the walls, making the entire structure fundamentally more valuable and a lot more resilient.
And then you have this number. $54.8 billion. This right here represents the sheer, breathtaking scale of the operation. So if that $10 billion in net income is the treasury in the center of the fortress, then the net premiums written, that's the vast territory this fortress commands. It shows you the incredible reach of their business, the sheer volume of risk that they are underwriting all across the globe. This isn't just a number, it's a measure of market trust and penetration on an absolutely massive scale.
Okay, Analyst, I'll give you that. These are some powerful, heavy-hitting numbers. $10 billion in profit is certainly no joke. But here's the thing. A single great year can be a fluke. We've seen it happen time and time again with other companies. So is this a one-time surge fueled by a lucky break, or is this performance built on a solid year-over-year structure? Show me the trend. I want to know if this fortress was just built overnight or if they've been consistently reinforcing its walls. Lead Analyst, that's exactly the right question to be asking. A fortress is only as strong as its history of reinforcement. And this table, it illustrates that point brilliantly. Just look at the consistent year-over-year growth. Net income is up over 11%. Core operating income, which is a great metric because it smooths out some of the one-time events and accounting quirks, is up almost 9%. And critically, you have to look at it on a per-share basis because that tells you about efficiency. Growth there is even stronger, over 13% for net income per share. This tells you they're not just getting bigger, they're getting better and more profitable for each share outstanding. This is no fluke. This is methodical, consistent, structural growth. They are doing the heavy lifting year after year after year.
Okay, so let's dig deeper. Let's get into the engine room of this fortress. Because every great structure, every single one, needs an unshakable foundation. For an insurance company, that foundation is something called underwriting discipline. It's not just about writing more policies and getting bigger. It's about writing the right policies at the right price. This is the absolute core competency. It is the bedrock upon which all that profitability we just looked at is built. And make no mistake, If this part of the business is weak, the entire structure is at risk of collapse.
Whoa, hold on a second. You're throwing around industry terms there. Underwriting discipline sounds great, sounds professional, but how do we actually measure it? How do we quantify it? Before you show me another giant number, break it down for our audience. How do we know for sure if their foundation is actually solid or if it's just marketing speak? What's the one metric we should be laser focused on here? That's a fair point. In the insurance world, it really all comes down to one crucial number, the combined ratio. And it's actually simpler than it sounds. You just add up all the claims the company paid out and all of its operating expenses. Then you divide that total by all the premiums the company collected. So any number below 100% means you're running a profitable underwriting business, period. The lower the number, the more profitable you are, and the stronger that bedrock foundation truly is.
And here is Chubb's number, 85.7%. So not just below 100, it's miles below it. Honestly, this is a number that most of their competitors would absolutely dream of hitting. And look at that caption, a record low. For the company, this isn't just good, this is exceptional, world-class performance. It tells us that for every single dollar in premiums they took in, they paid out less than 86 cents in claims and expenses combined. That 14-plus-cent margin, when it's repeated across tens of billions of dollars in premiums, well, that becomes the powerful engine driving their profitability. This is what a rock-solid foundation looks like in the real world.
85.7 is an undeniably strong number. I get it, but strength in one area can sometimes be used to mask weakness in another. So, is this incredible underwriting performance concentrated? Are they overly reliant on, let's say, the North American market to carry the whole company? Because a fortress with one really strong wall and 3 weak ones is still a very vulnerable fortress. So where is this strength actually coming from?
An excellent question, and it gets right to the heart of diversification. A true fortress has no weak points. It's strong from every direction, and that's what we see here. Chubb's underwriting strength is truly global. It's not concentrated in one spot. Their P&C, that's property and casualty insurance, their premiums are up a healthy 5.4% overall, but the key is that the strength is so well distributed. North America, their home turf, shows solid mature growth of 4.7%, but then look overseas. Their general business is growing even faster at 7.5%, and Asia is just on fire, up a massive 10.7%. That shows they're successfully capturing growth in crucial emerging markets. And it's not just one hotspot either. Latin America is contributing with really solid growth of 6.3%, and Europe is right there with them at 5.9%. This is a globally diversified, multi-front, and very powerful operation.
So we've firmly established the bedrock of underwriting profit. That's pillar number one. But a fortress also needs constant supplies and reinforcements, not just to sustain itself, but to grow and expand its influence. That's where the second pillar of Chubb's immense strength comes in. See, they don't just let that underwriting profit sit idle on a vault. They put it to work. We're talking about a powerful 1-2 punch, record-breaking investment income combined with multiple, diversified engines of premium growth.
Just look at this number. $6.95 billion. That's nearly $7 billion in adjusted net investment income alone. So what is this? This is the profit they make from investing that massive pool of premiums they collect, what the industry calls the float, before they actually have to pay out any claims. And you guessed it, it's another record. What this really means is that Chubb is firing on all cylinders. They have a highly profitable core insurance business, and then on top of that, they have this world-class investment engine that's generating billions more in profit. This is how the treasury of the fortress gets refilled and expanded every single year.
Okay, I see that. The whole engine is running incredibly hot right now. But what about the road ahead? Growth can't last forever. That P&C growth of 5.4% is solid, it's respectable, but it's not exactly explosive, is it? So where is the future growth going to come from to keep fueling this massive fortress? Are they actually finding new territories to expand into, or are they just coasting?
And that's where the story gets even more interesting. You're absolutely right. P&C growth is steady, it's strong, it's the core. But look at the other engine they're firing up. Life insurance. Net premiums written in that segment are up a staggering 15.1%. That's nearly triple the growth rate of their core P&C business. What this shows is that they are successfully diversifying their growth streams. They're pushing hard into the absolutely massive Asian life insurance market and other consumer lines. This is not a company that's resting on its laurels. It's actively and aggressively building new high-growth wings onto its fortress.
All right, Analyst. You know what? You've built a very, very compelling case. I'll admit it. A fortress with a deep treasury, solid foundations, and powerful new growth engines. From the inside, it looks impenetrable. But no fortress exists in a vacuum.
I'm looking out the window and I see storm clouds gathering on the horizon. Economic clouds, political clouds, geopolitical clouds. These are the cannons and the trebuchets of the modern world, and they can test even the strongest walls. So let's stop admiring the fortress for a minute, and let's talk about the very real external threats. Let's really test these foundations.
So I'll just ask the question directly. This performance we've been talking about is impressive, there's no doubt about it. But is it built on the solid ground of a stable, predictable global economy, or is it built on the shifting sands of a world that is facing immense, maybe even unprecedented uncertainty? Because you know as well as I do that the best-built fortress in the entire world can still crumble if the ground beneath it gives way. What are the real macroeconomic risks that could bring this whole beautiful structure down?
And you're not the only one asking that question. The man in charge is asking it too. This quote, this isn't from some critic or a short seller. This is from CEO Evan Greenberg himself in his annual letter to shareholders. He is looking at the exact same storm clouds you are. He's the one acknowledging the great deal of uncertainty. He's pointing to the growing protectionism, the geopolitical tensions. This proves that this is not a management team with its head in the sand. They see the threats, they see them clearly, which is always the first and most critical step in preparing to withstand them.
And he gets very specific about what these risks are. These are the potential cracks that could appear in that solid foundation we were just talking about. He's talking about growing geopolitical instability. That directly impacts risk assessment for a global insurer like Chubb. He points to protectionism and nationalism, which threaten global trade and therefore threaten their entire global business model. He mentions policy uncertainty, which makes it incredibly hard to predict things like inflation and economic growth, key inputs for their pricing models. He even calls out the U.S. equity markets as being priced to perfection, which is a pretty clear warning of potential volatility that could impact their massive investment portfolio. These are serious, systemic risks that management is actively monitoring.
Now, acknowledging the risks is one thing. That's important. But having a concrete plan to deal with them is something else entirely. So let's shift our focus to their forward-looking strategy. This isn't just about hunkering down behind the walls and hoping the storm passes. No, this is their actual blueprint for actively reinforcing those walls, for strengthening the fortress to ensure it can withstand the exact pressures we just outlined. This is all about being proactive, not reactive. And the first piece of hard evidence for their confidence is this number right here, $4.91 billion returned directly to shareholders in 2025. That's through a combination of dividends and share buybacks. And this is a massive signal. A management team that sees imminent danger, that is truly scared about the future, does not hand out nearly $5 billion in cash. This is an act of supreme confidence in their balance sheet, in their future earning power, and in their ability to navigate the uncertainty ahead. They're effectively telling their investors, we've built this fortress to last, and we have more than enough capital to both defend it and to handsomely reward you.
Okay, returning capital definitely shows confidence in their current position. I get that. But how are they going to keep growing the business through a potential global storm? What's the actual plan? Where are they placing their bets to not just survive this period of uncertainty, but to actually thrive in it? Show me the blueprint. Here it is, and it's a very clear multi-pronged strategy designed for all-weather performance. First, they're doubling down on global mid and small commercial markets. These are often less volatile than the giant corporate accounts, and they really form the backbone of the global economy. Second, they're leaning hard into their new growth engine, expanding those global consumer lines. That means more U.S. personal insurance, but especially that high-growth Asian life and A&H, that's accident and health insurance market. Third, and this is crucial, they're future-proofing the fortress. They're investing heavily to lead in a digital age, using data, analytics, and AI to make their underwriting even sharper and more efficient. And this isn't just talk. They're tying it all to hard financial targets. A core return on equity, or ROE, of over 14%, and an even tougher measure, core return on tangible equity, or ROTE, of over 20%. These targets signal a deep commitment to highly profitable growth, not just growth for growth's sake. It's a clear, it's ambitious, and it's a very focused plan.
And this quote really brings us full circle. Despite all the risks that he himself just outlined, this is the CEO's direct forward guidance. He's not predicting a slowdown, he's not hedging his bets, he's anticipating an excellent 26, he's putting his own credibility on the line, projecting strong growth in operating earnings, and, once again, that powerful double-digit growth in both earnings per share and that all-important tangible book value. It's a statement of profound confidence in their blueprint and their ability to execute it.
So, when you boil it all down, this is the core tension, isn't it? On one hand, you have a company that is demonstrating near-flawless operational excellence. You've got record profits, record underwriting discipline, record investment income. It's a machine just firing on all cylinders. And on the other hand, you have a global environment that is anything but certain.
It's full of political tripwires, economic landmines, all things that could disrupt even the best-laid plans. It's really a classic battle between internal corporate strength and external macro pressure.
Which leaves us with the ultimate question that every single investor has to consider for themselves. We've shown you the strength of the walls. We've shown you the depth of the treasury. We've also shown you the storm clouds on the horizon that the company's own leadership is watching very carefully. Market skeptic. Look, Chubb has undeniably forged a powerful financial fortress. But with those global economic tremors growing louder every single day, the question remains, will its foundations hold firm? That's for you to decide. Thanks for joining us here at Iron Financial.